Hi, this is Jim Cunningham. We're going to talk about how to pass real estate, what lawyers call real property, under Prop 19, or I should say after Prop 19. Like, how does this work? Because Prop 19, a lot of people are unhappy with it. There is some good stuff we're going to talk about in Prop 19. Lots of people very unhappy. So Prop 19 really changed the landscape, and that was effective in February of 2021. It unwound or undid the parent-to-child reassessment exclusion, which is a mouthful. All that means is that parents can pass property to kids, and the kids keep mom and dad's low Prop 13 taxes. So kind of a good deal for many, many people, even tenants, right? Because, some of these properties, if you had to pay higher taxes, you might not be able to rent that property or even keep it for your tenant. So we're going to talk about how to minimize property taxes when you pass away, sell, or give property away. A little bit of a teaser here, or a little bit of a preview. That is called a change in ownership, a sale of property, a gift of property, and death. When somebody dies, that is considered a change in ownership. Change in ownership means, translation, property is reassessed. So change in ownership, reassessment. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for over 25 years, and we have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law, securities and insurance license, and a pilot and a real estate broker. So big background in kind of broad background. And these are our 12 lawyers at our firm right now. And we are laser focused in on helping a lot of times real property owners, but people transfer wealth from one generation to the next. So about estate planning, a lot of real estate planning, and we help out people throughout California and in other parts of the country as well. Go ahead and subscribe to our YouTube channel. If you're watching this on YouTube, you can click subscribe. I would encourage you to click the little bell, then you're alerted when we post a webinar. And we have, for those of you in the California Bay Area, now this is the San Francisco Bay Area, not the South Bay in Torrance, okay? We're talking about the Bay Area. We're going to have an event at our office on August 19th in San Rafael. So that's the county seat of Marin County. We're going to go over a whole bunch of stuff. This is going to be a great opportunity to meet us live. I will be speaking at that event in San Rafael coming up on August 19th. So disclaimer, I'm a lawyer. I'm talking. This is not legal advice. We're going to go over stuff very quickly. I will say that California property tax law is a very complicated area of the law. There are a lot of gotchas in there, and it's really not clear. You may think, oh, well, I can do this. And no, you can't do that. So this is, it's very important to hire an expert. And we're going to talk about that, which our firm is. So understanding Prop 19, what is Prop 19? For many people, it's negative. I will say there are some positives in there. I mentioned that. But Prop 13, really, to understand what happened during Prop 19 requires an understanding of Prop 13, which was passed in 1978, and Prop 58, which was passed in 1986. So I know there's a lot of numbers out there. Prop 13 is the one that keeps your taxes at 1% of the value, only increases 2% every year. Prop 58 allows the parent to transfer that property to a child, sale, gift, or death, and the property not be reassessed. So not be reassessed. So very, very important. So I'll give you an example. This is me as a kid. This is my parents. And for those of you car aficionados, that is a 1978 Lincoln Continental Mark V. It was the great car to have in 1977, I guess. So that's around the time my parents bought a condo. In fact, this picture was taken right around the time that that property taxes were rolled back to their 1975 levels. So what happened during Prop 13 in 1978? What happened during the 70s is property went way up. The average homeowner or property owner in California was paying well over 2% in property tax. And so the Howard Jarvis led this initiative to roll back property taxes to their 1975 values, right? So between 75 and 78, there was a rapid appreciation in real estate, roll back those properties back to their 1975 values, and very importantly, cap the amount of property tax at 1%. So taking it from about 2.6 down to 1. And then thereafter, that 1% property tax could only be increased 2% a year. That's Prop 13. And so what happens is, and this is a true story, my parents still own a condo that they bought for $24,000 in Ventura, is now worth about $580,000. Their property taxes are $633 per year. Now, this is the 1%. By the way, this is public information, mom and dad, anyone can find it. The property taxes are 1% of what is called the ad valorem value, meaning the assessor says, hey, what was the property worth in 1974 when they bought it? Was it worth in 75? And then we're going to add 2% a year. So what ends up happening is the property value goes way up, but the assessed value stays at about $63,000. So this is the 1%. And by the way, if you're a homeowner or property owner in California, you know that there are taxes beyond the 1%, right? These might be additional ad valorem or based on the value or the assessed value of the property. There are also parcel taxes. So what we're talking about here is the core Prop 13, makes the numbers a little bit easier, 1%, a little bit easier to calculate. So in the 1980s, right? So what happened? This property went up in value in the 1980s. We got Prop 58 that let my parents transfer that property to me, which they're both alive and they haven't done it, right? So that would have allowed them to transfer that to me. And I keep that $633,000 a year, $633 a year tax bill. So that's a really good deal. And this is really Prop 13 in a nutshell, right? This is, for people who've owned properties for a very long time, right? They have a very big benefit on property taxes, because what you'll see, if my parents were to sell this property, right? Let's say they sell this property to another family, right? Another young family. And that is a change in ownership. So when they sign that deed and they convey it to this family, they buy that condo in Ventura for $580,000. Their property taxes go from $633 to $5,800 a year. A lot of people think this is really unfair. Now, if you have the $633 a year tax bill, you say, well, it's fair. And if you're paying the $5,800, you probably think it's unfair, right? That just kind of makes sense. But it's very important to understand, because there was a change in ownership, that is what resulted in reassessment. So when I use the term reassessment, I'm talking about what the assessor values the property at for the purposes of telling the tax collector how much to put on the tax bill when it comes to determining property taxes. So stated another way, reassessment, we're not talking about cost basis. We'll talk about that later. We're not talking about the IRS. We're not talking about the Franchise Tax Board. We're talking about the county assessor. So when we say reassessed, that's kind of like the word assessor. And so what we're talking about is assessed value of property, which may be totally disconnected from its market value. Right in this example, the assessed value is $6,300, but the market value is $580,000. So our assessed value is $63,000. So that's the difference. There's a change in ownership. The taxes jump to, they're going up almost 10x. So right now, there still are benefits of Prop 13, even though Prop 19's passed. Property is assessed at 1% of its market value when there's a change in ownership. Death is a change in ownership. A lot of people don't realize this. If mom dies and, daughter's a trustee of a trust, maybe they're three kids, so daughter and two siblings. They sell the property, just pass out the checks to the kids, beneficiaries. 11 months later, there's a supplemental unsecured bill, right? Who pays that? The trustee is going to end up paying that out of the trustee's own personal funds, unless there's something called a refunding agreement. So it gets a little complicated. So just because mom dies, you think, hey, mom died, this low tax bill, we're going to close out the trust. Great. You got to watch that, because you're going to likely get that supplemental bill. Typically, it's about 11 months after death, more or less. Very important to understand, property is taxed at 1% of its assessed value. The property could double in value, but those taxes are only going to go up 2% every year. And believe me, the assessor's office is paying attention to that. There is an exception. If property goes down in value, your property taxes can be reduced, but that's temporary, because they can always, as the property comes back up, they can kind of go backtrack and they might raise your taxes 5% in a year, but really what they're doing is they're just making up the difference. So the maximum is 2% a year. And real estate is increased. I looked at that this morning. The St. Louis Federal Reserve publishes an index of California housing. This is broadly speaking, this is all California housing, has gone up 6.4% annually, and the taxes have gone up 2%. So if you've held a property for a long period of time, this Prop 13 is a tangible benefit that reduces your taxes year over year over year. There's a cautionary tale to that, is some people, I think, overweight property tax and forget about other things. And we're going to talk about that. So long-term owners of real estate really benefit from Prop 13. So Prop 19 had some negative effects. There is no longer the parent-to-child reassessment exclusion. What that means is when kids get a property from the parents, they are going to be reassessed now, right? Generally speaking, there is a carve-out for the family home. We're not talking about, there's a farmland exemption that really doesn't affect a whole lot of people, but it's very important to understand what we're talking here is typically residential, multifamily, commercial, industrial property, sort of developed property, not the farmland. This limitation is limited to the residence of a parent And then that child who gets that property must reside in that property. If that child stops residing in the property, that $1 million reassessment exclusion goes away and the property taxes go up. That was a recent sort of position that the franchise tax boards come out with. And each parent can no longer leave $1 million each. It was $1 million each. So if you did it right, it could be 2 million. You could double it up. So that's gone. So where does this leave us? So Prop 19, if for a lot of people, this was horrible in terms of wealth creation. It has been, the Howard Jarvis Institute has sort of characterized this as a death tax. It's a form of a death tax. So you can, I'm not going to make a political statement one way or another, but it is triggered at death. So in a sense, it kind of is a death tax, right? Your property taxes go up. I can certainly see the argument. This passed narrow majority, 51 to 49%, and repealing Prop 58. So there is good stuff. There's good stuff in Prop 19 I do want to talk about. So if you're watching this or listening to it, this allows you to take your property taxes with you anywhere in the state of California up to 3 times in your lifetime if you're 55 or over or the victim of a wildfire. And we covered this in other webinars and other podcasts. But this is even if a property is more expensive. So this is, I think, a real expansion and really a case for staying in California. And this has been kind of a topic lately is, you hear people leaving California. There are some people who actually moved to California to retire, and that's an individual choice. But when you kind of look at the cost of living in California, I would say weighing in the favor of staying in California is if you are benefiting from Prop 13, it keeps your property taxes very low. You move to other states, their property Texas, it's 3%, right? So if you buy a $500,000 home in Texas, you might have a $15,000 a year property tax bill instead of a $600 property tax bill. So these are all things and we have a webinar on that. Should you retire? Is the grass really greener on out of state? So, and this is very important. Prop 19, even if the property is more expensive, so you can go up in property. It used to be that you couldn't carry over under Prop 60 and Prop 90. You could not carry over your property tax base if you went to a more expensive home. But here with Prop 19, if you do go to a more expensive home, you basically pay the difference. And we'll talk about that in an example. And again, this only applies to people who are over age 55, severely disabled, or victims of a wildfire or other natural disaster. So let's talk about downsizing. Let's say husband and wife buy a home in Pasadena in 1980 for $200,000. Today it's worth $1.2 million. You're kind of making up these numbers. Maybe it's a bungalow district, right? They pay property tax of about $4,600 a year. And let's say their kids move to Northern California. They move to the Sacramento region, Roseville. Placer County is one of I think it is the fastest growing county, or number 2 in California. A lot of people, a lot of building going on, a lot of young families moving up there. So they want to be close to the grandkids. They move to Roseville, which is in Placer County, and they buy a $900,000 house. Well, they get to take their assessment of, the $468,000 to the new home, so that their property taxes are only $46.86 a year instead of $9,000. So a meaningful savings, yes. And they might have some other capital gains tax issues here. And we've covered that in other webinars because the gain exceeds $500,000. But bear in mind that, and the example is the reason I'm giving you this example is that you can take your property tax base to a new property. And that really is a benefit under Prop 19. Now, let's say they go up in value. Let's say instead of moving up to Roseville, because it's 109 degrees on Sunday, they say, let's move to Carlsbad. The weather's better, right? It's by the beach. Well, you're going to pay a lot more, right? So you're going to pay $3.2 million for that house in Carlsbad. And what they end up doing is they move the property and the difference beyond the assessed value, right? The sales value of the house in Pasadena of 1.2 million and the purchase of 3.2 million, that delta is 2 million. That 2 million is added, right? It's added to the assessed value of the house. So that means they have a $24,000 tax bill and not a $35,000 tax bill if Prop 19 did not exist. So if you're looking to upgrade your house when you move, sell your home, buy another home that's more expensive. It used to be you could not use this benefit. Now it's a benefit for homeowners. So very important part of Prop 19. And then you can couple this with, well, if I leave the house to my children under Prop 19, and you can kind of do the math on that. And we do that a lot for clients. Well, Prop 19 takes away the parent-to-child reassessment exclusion. So that is something that it is completely gutted. It's been eliminated. Stick a fork in it. It's done. You can't use it for a vacation home. You can't use it for the lake home. You can't use it for the beach house. You can't use it for investment property. You can only use it for farmland and your principal residence. So That's if you have your homeowner's exemption or it's eligible for a homeowner's exemption. Again, we covered this in other webinars and podcasts, but there are all these other types of property, commercial, multifamily, other rental property is reassessed. And so how does it work when a parent dies and leaves property to a child? So for a lot of people, when Prop 19 was passed in November of 2020, but before it was became law, February 15, and after, we were really busy, right? A lot of people came in, they say, hey, I want to get this beach house, this vacation house to my kids so that they can keep the low property taxes. Well, here's the problem with this. And again, I'm talking about what happened in the past, because if you missed the boat on this, it's not all roses and sunshine. Okay. There were some negative impacts on this. Okay. So if mom has this vacation home she bought for $120,000 in 1980, it's worth $2 million. Assessed value is $281,000. Property taxes are very low. A lot of people gave these properties to their kids. They said, I don't need it. Look, it's, you're using it. Here, you take it. I'm going to give it to you. The problem is if the daughter gets it as a gift, the daughter now has a low cost basis. So what do I mean by that? Well, cost basis is acquisition price plus improvements minus depreciation. So let's say the cost basis is $120,000. If the daughter says, I don't like a beach house, I want a mountain house, and sells this property, the daughter may be facing a significant capital gain, right? So this was kind of the downside of this planning, but this is an example of a parent-to-child reassessment exclusion. So it used to be that mom could transfer the property to the daughter, and the daughter keeps the low property taxes, saving $17,000 a year, but the daughter had a low cost basis. Then we got together as we saw this issue as lawyers. We got a study group together of probably 30 or 40 or 50 attorneys and used, this is during COVID, right? We're using Zoom and we worked through and we figured out a way to craft a Prop 13 trust. What is a Prop 13 trust? It's a way to make a transfer of property to a child to have the gift be completed. And it's very important that the gift be complete for property tax purposes. And I won't get into the weeds on that, but you really do need to have a complete gift for property tax purposes, but still get an adjusted cost basis at death. So here, mom still transferred the property to the daughter with a Prop 13 trust. And then when mom passes away, that daughter gets an adjusted cost basis. So she really kind of has her cake and eats it too, meaning if she sells it for $2 million after mom dies, no capital gain. Right? That's what adjusted cost basis means. It means the basis, that cost basis, which is acquisition plus improvements minus depreciation. And we'll just say it's 120, right? If daughter sells it while mom's alive, yeah, there's a big capital gain, right? Almost a $2 million capital gain. But if she waits until mom dies, then there's no capital gain on that $2 million. If she sells it for $2 million. The challenge though with this is these kind of are at odds because you're not going to want to sell the house, right? I mean, you might, but the whole point of doing this planning is to keep these legacy properties in the family. Although some people, what they've done is daughter could then convert that to a personal use asset, meaning her residence, right? Her primary residence. And then she could sell that, right? If she's over 50, 55 or over, and move her Prop 13 tax base to a new property. So if you got all of that, good for you. There are a lot of planning strategies on Prop 13. So let's talk about the remaining available strategies. And this is probably why you're watching this. What can we do now that the parent-to-child reassessment exclusion is gone? Well, there's a really big exclusion that did not get a whole lot of attention when we had the parent-to-child reassessment exclusion because we didn't need it. And this is called the co-tenancy exclusion. I would say this is a narrow exclusion. So, and there's an open question of law. And if you're watching this, if you work for the Board of Equalization, you might have gotten this question on your desk because we asked it about 2 weeks ago. And I'll get to that in a minute. So what is a co-tenancy exclusion? All right. What this means is two people are on title, one dies. It is both the residents, right? So two people are together. And where this comes from, this was enacted in 2013 before marriage equality. So this is when you had people who under law could not get married, but they were a couple, right? Well, now that's a different situation now, but these people were married. Could not get married. They were a couple and one would die and the other one's getting reassessed. They say, well, this isn't fair. We can't get married. And so, what are we going to do? So the legislature came up with the co-tenancy exclusion, meaning two people live together. They own 100% of the property. So only two people on title. They have to be on title for a year before death. Somebody has to die. So someone's got to die in this. It has to be the principal residence of both co-tenants for that 1 year period. And then the transfer has to occur because of death. And the surviving person must file a form on the county level saying, hey, there should be a reassessment exclusion based on the co-tenancy exclusion. So it's not available. And here's the kicker. It's not available if another exemption is available, such as the parent to child reassessment exclusion under Prop 19. But here's the open question. Let's say a mother and a daughter are living together. They're both on title. And the mom dies, and now the daughter's solely on title. And they were both living together, right? And it's actually very common for a parent to live with a child, certainly toward the end of life. Maybe the daughter's taking care of mom. Maybe the daughter's moved into mom's house and mom puts a daughter on title. Separate topic. So the question is, if there's a parent to child reassessment exclusion under Prop 19, is that available? Well, yeah, because the daughter's going to continue living there. But what if that gets reassessed because there's more than $1 million in the difference between the assessed value and the market value at the date of death? The open question is, do we then pick up the co-tenancy reassessment exclusion? I don't have the answer. And again, if you work at an assessor's office or the Board of Equalization, please reach out to us with the answer. One way or another, we'd like to know, because this is a real issue for many of our clients. So, does this result in some reassessment? Maybe it's a hybrid, right? Maybe if you stop using it as your home, you might get reassessed, and the other one, you would be falling under the co-tenancy exclusion. I have no idea. And this is the world that we live in now, which is there are rules, and we don't really know all of the regulations attached to the rules, for lack of a better term. So let's take an example. Grandma owns a lake house and it's her primary residence. Grandson moves in to help take care of grandma, and the lake house is grandson's residence, right? They do this for over a year. And grandma adds grandson as a joint tenant. Not great for taxes for a lot of reasons. There's no reassessment. As long as grandma's on there as a joint tenant, she can convey the property from grandma to grandma and grandson. More realistically, grandma should probably add grandson as a tenant in common for 1%. And there's a little bit of 1% reassessment. Grandma dies, and this is very important, under grandma's trust, or will, I suppose, but under grandma's trust, the property goes to the grandson. So the grandson gets the property. So this may not work for everyone, right? I think you can see why. And this assumes that grandson has a parent who's alive, so there's no grandparent to grandchild exclusion. So the idea here is that you're able to avoid reassessment, right? This requires artful estate planning. We're also going to have to deal with the issue of, well, if the grandson gets the lake house, what about the other people, right? So there are planning methods to work within this framework. Do we see this? Is this common? No. Is it common for a grandchild to move in with a grandparent at the end of the grandparent's life? Yes. And so maybe there's an opportunity there. And so if you're looking at this and you go, hey, that's us. It doesn't have to be a lake house. It could be a house in a city. That may be a planning strategy that you could investigate, and we could certainly help you with that. So what else can be done after February 15, 2021? So what are some basic frameworks? Well, I would say this is the rise of the artfully crafted LLC. I would say a Prop 13 compliant LLC. So I would consider purchasing real estate. So this is when you buy it. And, the problem is, can you put your home in an LLC? Not really. It's a personal use asset. I mean, Governor Newsom lives in a house that's owned by an LLC. I don't know who owns it, but it's really, and this is where reasonable minds can differ. Some lawyers say, Jim, you're worried about it too much. You can put your house in an LLC. I'm not seeing the business case for a personal use asset in an LLC. I just don't see it. So what we're talking about here is non-personal use assets, right? This might be rental properties, industrial, commercial properties. If you buy it with an LLC, that LLC becomes the original owner. What does that mean? It means when the property went in the LLC, the property was reassessed. So if you set up an LLC and buy a property from somebody else, that's going to get reassessed. It's a change in ownership. But the advantage here is the LLC is what is called the original owner. And that's a very powerful distinction between an LLC that is not an original owner. So if I own a property, I can put it into an LLC. And as long as my 100% ownership, right, when that property goes into the LLC, as long as I own 100% of the shares of the LLC, the property is not reassessed. That's a proportional interest transfer. So you can put property into an LLC if it's done correctly and not be reassessed. If it's done incorrectly, the whole property will be reassessed. So this is very, very important. When you deal with LLCs and real property, if you don't know if you're a lawyer and don't know any of this stuff, you need to associating counsel, refer it out, learn, don't just do. And certainly if you're an individual who's trying to do this on your own, I think it's a really bad idea, because you can end up taking an action that will result in a reassessment, and you can't unring the bell, right? You can't pull the cream out of the coffee. You're stuck with the reassessment. So if the property is purchased with the LLC, that's good. If it's put into the LLC after it's purchased, less good, but maybe there's some room in there where we can work. All right. Use of Prop 13 compliant LLCs to hold real property. What do I mean by Prop 13 compliant? Meaning, if there are Prop 13 protections with this LLC, the operating agreement and what you do with the LLC doesn't really screw things up and result in a reassessment of the property, which is very easy to do. And we have a couple of examples. So a limited liability company, why not a corporation or a partnership? We're going to cover that. But a limited liability company has less stringent corporate formalities. It personally protects the owners from liabilities. You're always responsible for your own negligence. Remember that. So if it's you doing the thing, you're going to be liable. But in terms of, if a rental property is in an LLC and something happens, it's going to limit your liability. It's the idea to the LLC. Any individual or entity can be a member of an LLC, but not a bank or an insurance company. And they don't pay taxes on their profits directly. These are pass-through entities typically, and they're reported on your own tax return. So there's no like corporate tax like there would be with a C Corp. So limited liability company in Prop 13, LLCs should, but they're not required to have an operating agreement. And this is really important on the Prop 13 compliant LLC. There's some special terms that we put in the operating agreement so that people won't inadvertently cause a reassessment of the property. The assessor, when you put property into the LLC or acquire it with the LLC, the assessor will ask for the schedule of members. They want to know who owns the property, right? Certainly when you transfer it to the LLC, they're going to want to see that schedule of members. And you don't know what you don't know, right? And if you're a lawyer doing this, and I will say that CPAs do a lot of things. We do see some CPAs, they say, oh, you don't need to go to a lawyer and waste legal fees on an LLC. That's really easy. I can do it for you. I think that's practicing law without a license. So I think it can be a bad idea, especially with real estate, because there are very particular rules that many people, even most lawyers, are completely unaware of. Okay. This is just the way it is. So if you're going to have a piece of real property go into an LLC, I would suggest you reach out to us, reach out to, another law firm that's competent in this area, not just LLCs, but also real estate and property taxation. And there aren't many of us. So it's a little tough. If there's a change in ownership, the property is reassessed. So if there's a change in ownership, the whole property is reassessed. This is really important to understand. If there is a change in control, if I am in partnership with someone else and we own 50-50 and I am in control and the control shifts to the other person, the whole property is reassessed. If I own 50% and I buy the other 50% of the LLC units from my partner, that means I get control, right? I have to report that to the Board of Equalization. Many people don't. And if it's an entity, they can go back for back taxes from the point where there was that original change in ownership. It could be 30 years ago. So you're stuck with a big tax bill. Everything, by the way, with taxes, everything sees the light of day, and you can put your head in the sand and tell yourself whatever story it's going to be. But believe me, the Board of Equalization and the assessor's office, very aggressive. And rightfully so, right? Because people should pay the tax if they do something, right? That those are the rules. So really, this is very, very important that you follow the rules and you get somebody who knows what they're doing. This is another one that's a little bit tricky. As I mentioned, if I own 50% and maybe I acquire 1% from my partner, that's a reassessable event, right? That's change in ownership because now I've gone from 50 to 51%. Leases in excess of 35 years. This is a gotcha. If you execute a lease, and what I'm saying is the lease plus all extensions, if that is more than 35 years, it's a change in ownership. When the lease terminates, it's another change in ownership. So if you have commercial property, you really need to pay attention to your pass-throughs, right? Can you pass through property taxes as they go up? Are you limited to once during the lease term or whatever it is? So on these commercial leases, make sure you've got a good lawyer who understands this. And, if you do have a change in control or a change in ownership based on who owns the LLC shares, you want to make sure and be able to pass that through to your tenant if you're able to do so by contract. So going forward, I would say using a limited liability company as the acquiring entity, right, is a great way to preserve Prop 13 indefinitely. And we'll see what I mean by indefinitely in just a couple of slides. So an LLC can be taxed as a corporation, a partnership, or a disregarded entity. We do not see LLCs taxed as corporations owning real estate. I would say what most people do, and probably the way to do it, is either the disregarded entity or partnership, and we'll explain why. If one person owns the shares of an LLC, that can be a single member LLC. And if there's more than one person, it's more like a partnership. The exception in California, if it's community properties, we're a community property state and it's community property, two spouses can own the shares and still be a disregarded entity. So not having to file a partnership return. Owning real estate in a corporation. And you might be thinking to yourself, what on earth does this have to do with Prop 13? A lot, because a lot of property is owned in LLCs. A lot of legacy farmland is owned in corporations. Why? Because when Grandpa put the farmland in the corporation in 1953, that's all there were. There weren't LLCs. And if Grandpa owned the farmland and he didn't want a partner, that was his only choice, right? Is the corporation. And that's probably a C corporation, because S corporations didn't exist in the 1950s. So very old school. We really don't see this in the real world. If you are stuck with a property in a corporation, it might be better to convert that entity to something else. And that's something we could certainly help you with. But what I'm doing is I'm hitting the highlights, because people ask me, is it better to have real estate in a corporation or an LLC? Should it be taxed as a corporation or taxed as a partnership? So partnership or disregarded entity with the LLC is the way most people go. It's more flexible. Here's the other issue. You do not get an adjusted cost basis in corporate assets if you own shares in a corporation. So meaning, if I own this property and I bought it for 100,000 and it's worth $1 million and it's in a corporation, when I die, my estate does not get an adjusted cost basis in the property inside of the corporation. You might get an adjusted basis on the shares. That just kind of creates a tax issue. So if the corporation were to sell that property, you might be looking at unnecessary capital gains tax. So downsides of a corporation, double taxation with the C Corp and 1.5% in addition to capital gains taxes. In an S Corp, the LLC does have a minimum franchise tax of $800 a year. Some people get wrapped around their axle on that. I would say I wouldn't worry about it too much. I mean, you need to pay it. That's the way it is. It's California. Everything's more expensive. A loaf of bread's $9, whatever. So taxation of an LLC, disregarded entity or partnership, the difference. So if you're going to buy a piece of property with an LLC and you got, wow, man, this sounds complicated. A disregarded entity has no federal income tax return. There's only a California state return, and it really is the simplest tax structure. And this is commonly used for real estate. There is an outside unresolved issue is, do you get an adjusted cost basis on assets held inside of a disregarded entity? I've not found a good answer on that. And I've talked to a lot of smart people. I think most people do treat it as getting an adjusted cost basis. Taxed as a partnership, you have to file your federal Form 1065 as well as a state return. And you do get an adjusted cost basis at death, and you make that 754 election on the 1065 in the year that a partner has died. So CPAs can miss this. So it's really important when your CPA asks you, has anyone died? And if you're running a partnership, you need to know if any of your partners have died. You may not know. And that has to be made, that election has to be made on the first return. It cannot be made on an amended return. And this is commonly used for, a partnership is common structure for real estate. So a little bit in the weeds on taxes, but it's important to pay attention to this. And this is really where the lawyer and the CPA and the real estate professional need to work together to determine which entity. I'm not going to get into AB 150. We cover that in other webinars. That's a method of paying your state income tax on the entity level at a lower rate of 9.3% and have that be deductible on your federal return. We cover that in other areas, but the partnership, you can do that. A disregarded entity, you need to have two members to do that. So maybe if you're single, your living trust and you, and if you're married, it could be spouses. So again, down in the weeds on the tax stuff. Taxes in S Corp, you got to file your 1120S. And if it's a C Corp, you're filing your 1120. You do have state returns. Again, we really don't want to see these with real estate. So I think the key takeaway on the taxation of the LLC is, if you're going to own real estate in an LLC, you'll likely end up with an LLC tax as a disregarded entity or partnership. So if that's the only thing you remember from this, I think I've done my job. And you likely won't be chosen. You likely will not choose, if you have a choice, to be taxed as a corporation. And again, there's an open question as to whether, if a disregarded entity gets an adjusted basis in the property. I think that's a topic for a technical webinar. I think most people treat that asset as getting, having an adjusted cost basis. So let's look at an example, and then we have a lot of questions here. We're going to look at an example. I'm going to hold the questions to the end and then go through the questions. So Helen want to create H&W, and we're almost done. H&W LLC. This is a Prop 13 compliant LLC. What do I mean by that? What I mean is baked into the operating agreement are very specific terms that prohibit people from doing something stupid, frankly, that would cause a reassessment. So essentially they have to go back to the lawyer, or they have to go to somebody to say, hey, we need to modify the terms of this agreement in order to do what we want to do. And then hopefully the person goes, oh yeah, if you do that, the property's going to get reassessed. So the idea there is these are some built-in guardrails, so you really can't throw a gutter ball, to use a bowling analogy. So in this situation, HW LLC, Howland Wanda LLC, yes, very creative. They buy a vacation home for $1 million and rent it out on Airbnb. I think that's a terrible idea. That would drive me nuts, but they do it and they love it. So, but this is really important. The LLC buys the property. Now the home's worth $3 million. So when the kids inherit the LLC, and this is very, very important, when the kids inherit the LLC, so long as nobody gets more than 50%, and so long as in this case, so long as really no one has control goes away, this property will never be reassessed. And you can add zeros to this, all right? This is a really big deal. So if you're going to buy, if you're in this sort of long-term, hey, I'm buying property, I'm building this portfolio, I want to benefit from Prop 13's cap of 2% increase per year, even though property is increasing historically at 6% a year. Yeah, it goes up, it goes down. This is a real long-term play, right? So it does make sense to consider an LLC for this specific purpose, because under these facts, there is no change in ownership. And in fact, this property, if it's done correctly, might never be reassessed. So very, very, very important. This is key though. The property is not transferred to the LLC after it's acquired, right? It's purchased with the LLC. Now, really, if you put the property into the LLC and trigger a reassessment, you do get original owner status. So could you do this after the fact? Yes. That's something we could talk about one-on-one. Well, let's say you only have one kid, right? You don't have 3 kids. What do you do? If this LLC goes 100% to the kid, to Howland Wanda's son, it's going to be reassessed. He's got more than 51%. But if it goes 49% to the daughter-in-law and 49% to son and maybe 2% to the grandkids, it's never going to get reassessed, right? And maybe it goes 25% to a son and 25% to each of the grandkids, whatever. Just no one can have more than 50% is the idea. So you can have 50, you can't have 50 in a little bit, you can't have 51. And then this control issue, this is, again, going back to the operating agreement, you have to be very careful how you address control. If we give son control after mom and dad die, that's going to be a problem. So we need to address that in the estate plan. We need to address that in the operating agreement. This is not for amateurs, right? This is very technical, and it's something that is very important and should be done with experts. And we are experts, so we handle this all the time. Half a loaf. So what do I mean by half a loaf? Well, what if you go, shoot, we already have it. We didn't buy it with the LLC. We just want to mitigate the downside. What can we do? Half a loaf is when people sell, die, or give away real property, that's a change in ownership. Meaning, if I transfer a 25% interest in a piece of property, it's going to be reassessed 25%. So 25% of the value of the property is reassessed. You only get one tax bill. And if you say, gee, well, if this person dies and it's reassessed, but I'm still alive and the taxes go up, I don't think that's fair. I don't think I should be responsible because the taxes went up because this other person died. That's when you have a tenancy in common agreement, because that property is reassessed. There's only one tax bill. It's not like, oh, your portion was reassessed and your portion was reassessed. One tax bill per parcel. So understand that transfers between spouses are not changes in ownership. Transfers between registered domestic partners are not changes in ownership. The term registered domestic partner and spouse is interchangeable under the family code in California and the probate code under law. So those are not changes in ownership. I can transfer a property to my spouse and that's no change in ownership. So long as no more than 50% of an LLC is sold, given away, or the owner of an LLC interest dies, right? So remember, sale, gift, death is change in ownership, and there's no change in control. the property is not reassessed. So if I have my property in LLC, I could sell 50% of it to somebody else, or I could sell 49% of it to somebody else, not reassessed. Could I sell 50? Yeah, probably, as long as there's no, I guess control would go away. There's no change, right? Or maybe I keep control, whatever it might be. But my point is that if I sell 25% of an LLC, no reassessment. If I sell 25% of the property that I own, reassessment. So but it's binary. Once you cross that 50% threshold, the whole property is reassessed. So it's an all or nothing game. So let's look at mom has a beach house and it's assessed at 500,000 and worth 3.5 million. Mom gives 51% to son in a Prop 13 trust, right? Now, why do we do this? So remember I mentioned the Prop 13 trust earlier. We did this because son's going to get an adjusted cost basis on the property. The way we write this trust is in a way where the gift is complete, but then when mom dies, it comes back into her estate. Now, this might not be good for death tax purposes, but we're not talking about that. We're talking about property taxes, right? So 51% goes to son in a Prop 13 trust. 51% of the property is reassessed. The taxes go from $5,000 to $20,000 a year. Mom puts 51% of that trust into an LLC and her 49% into the LLC. When mom dies, there's no reassessment because not more than 51% not more than 50 is transferred, and son, right, can get the 49% because he already has control, right? So this saves son $15,000 a year now, and son gets an adjusted cost basis. So this might be a situation, you could use this as an investment property. If maybe the beach house is being rented and they go, mom's 95 and we have some basis issues. We want to avoid this reassessment. Even if you're going to keep it for a year or two, you think about that year or two, you're going to have to be reassessed. Again, probably a narrow set of facts. But again, the reason I'm going through this is the concept of half a loaf. You can get halfway there. And, if you have estate tax issues or death tax issues, there are other planning strategies where you would not be getting an adjusted cost basis, but very important to have proper planning and people know what they're doing. I'm going to close with the step transaction doctrine because I talk to a lot of people. I talk to a lot of clients. I talk to people who are in the tax professionals. You really need to be aware of something called the step transaction doctrine. What is that? The step transaction doctrine is a judicial doctrine in the United States that says that if you have a series of formally separate steps and they're just going to smash all those steps together, right? So if A, then B, if B, then C, if C, then D, and you say, look, well, I'm just doing these separate steps. No, they compress. You go from A to D in one hop. This applies to income taxation, capital gains, and property taxation. I will say that people try and game the system and it doesn't work because we hear the horror stories, right? We talk to assessors, we talk to people at the Board of Equalization, we look at the case law, we look at the cases coming through, and we talk to people who are in a real pickle. So I will tell you, this is a cautionary tale for you as a consumer. If you're watching this, if you're saying like, hey, this is me and I'm going to do this stuff, you really have to be careful about this because the assessors aren't stupid people. These are very smart people and they're wary on how people game the system. And a lot of people get nailed on this. So they're trained not only internally, but by the Board of Equalization on how to identify a step transaction. I'm going to give you the example. Here's an example of a step transaction. Remember, we talked about LLCs and gifting. Hal owns a lake house. Hal transfers at 9 a.m. He transfers the lake house to an LLC and then gives 50% of the shares to his son. And then his son's sitting at the same conference table with the lawyer. Then they sign a deed taking the property out of the LLC. And then, and so Hal and son each own 50%, and then they put it back into the LLC, and then Hal gives 50% to his daughter, and then son and daughter take the property out, and they go, see, look, no more than 50% changed hands, no problem. This is a classic step transaction. If you do this and turn it in to get recorded, the assessor is going to collapse all these transactions and say, there's a change in ownership, full reassessment. So this is a cautionary tale, really bad idea. And guess what? People do this all the time. And it's just not a good idea. So the bottom line is find an expert advisor, seek advice. And, a lot of times if you're buying real estate, a savvy lawyer is going to suggest that you buy it with an LLC. And if you care about Prop 13, you really need to go to a lawyer that understands the Prop 13 issues. So you have a Prop 13 compliant LLC because a lot of lawyers don't understand it. A lot of people try and do it on their own. CPAs might try and help, out of the goodness of their heart to save their clients money. I don't waste money on legal fees. I agree. I don't think anyone should waste money on legal fees. There's value here, right? We don't charge a fee unless we can add value. And then follow the advice. I mean, really, if people advise you, and again, we've had cases in the past where people haven't followed advice and they come back in and they say, you were right. I did this. I went to took this other path, and now we've been reassessed. I'm like, yeah, well, we told you were going to get reassessed. So that's the bottom line. Now, is consulting with a lawyer enough? And I will get to your questions in just a couple of minutes. I would really recommend considering assembling your A team. Now, this is I would say, a specialized California trust and estate lawyer who understands these issues, right? Especially the Prop 13 issues, CPA and financial advisor. Also, estates over $10 million might benefit from our multifamily office service. And the book, Savvy Estate Planning, I wrote that book. It's in its second edition. It really covers many of these issues, covers a lot of core issues about estate planning. And basically, Savvy Estate Planning is the book. It's what you need to know before you go see the lawyer. It's kind of going you through all the questions that a lawyer should ask you. And frankly, if that lawyer is not asking you the questions that are in that book, find another lawyer, because these are just basic, elemental estate planning questions to get you thinking about things. And I would really encourage you to get the book. The family office services, people need an A team and they don't know what to do. These are high net worth families. They have financial, tax, and estate planning issues that aren't fully coordinated. So if you feel like, I go and talk to my lawyer, and then I talk to my CPA, and then I talk to my 3 financial advisors, and I'm still confused, and I feel like I'm not really taking advantage of things, we have many clients who let us coordinate those people, kind of translate for you, and get a game plan together so that you pay less tax, right? That's the ultimate kind of drive behind this, and create more intergenerational wealth for you and your family. And I think too often people overpay on taxes and fees, and really they're missed opportunities. So, if you have multiple financial advisors, one advisor might sell Apple and another one buys Apple on the same day. Well, that you're subjecting yourself to the wash sale rule. So there are a lot of reasons why you want to coordinate all your advisors. And if you want a truly multi-generational wealth, I would say consider our family office. And again, that's for clients typically over 10 million in wealth. And it's really a year-long engagement, a year-over-year engagement, and we really help families with the complex nature of many of these estates. I want to thank you for watching. We are going to get to some questions. Our offices are located throughout Northern and Southern California, and in the San Francisco Bay Area, the capital region, which is the Sacramento area, as well as Southern California. And we have our workshop coming up in San Rafael, which is Marin County. That's in the North Bay. That is not South Bay Torrance, people. It's going to be San Francisco Bay, and it's a beautiful, beautiful location. So a great place to go to get out of the heat if you're in Northern California and a little warm. And we are going to be talking about the 2026 estate tax exemption sunset. Taxes are going up January 1, 2026, unless we elect a president and a Congress that can actually pass a bill and do something. I don't know. I'm just going off what the law is, and the law says in 2026, taxes are going up. So if you have an estate of over 5 million, you're going to want to pay attention to this. Subscribe to our YouTube channel, because it's a great way to stay current on everything. And we're going to cover questions. If you're watching this on YouTube, you are going to magically just roll to the next video. And we really encourage you to go to our website and register for one of our webinars so you can answer questions, but we're going to answer those questions right now. So if you're watching this on YouTube, just keep watching.